I want you people to listen because I'm sick and tired of lefties not understanding economics, including myself, okay? We're all going to try our best. We're going to sit down. We're going to be good kids, and we're going to learn. Hello, Rage Pope.
Hey, Vosh. How's it going?
Doing great. How you doing?
I'm doing pretty well. I got a huge bump from my conversation with Destiny, and so I'm hoping to go for partner after this call today. So,
Wait, are you a liberal?
I mean, yeah.
Fuck. We shouldn't be talking
yeah.
publicly. Can we do this off stream? I don't want to give you any. I don't want to bolster your political movement.
No, it's fine. We have influence in the real world too. So whatever smattering of
I
support
know.
you
So
have
we gotta
online,
the left right now. We basically just have online. We need to hold on to what we can. Okay. Let's take this point by point. Okay.
Yeah, sure.
The stock market. What is it?
So the stock market is basically a place where people can go to trade publicly traded companies so they can invest their capital. So when you get paid, instead of leaving your dollars in your bank account, which aren't really doing anything, you can assign it to somebody or lend it to somebody essentially who can go do something productive with it. Right. So this can be someone who's, making cars or making buildings or making bombs or whatever happens to float your boat. You can kind of purchase a share in their company, and then they can use that money to help grow their company, employ new people, build new factories, things like that. You can also participate. So a share is literally a share of the company, right? Just like you would have a share of a commune, well, you have shares of a company, but the distribution is a little bit different, right? If I created a company, I could create myself 1,000,000 shares and assign them all to myself. And then I could go out and sell those to individual investors, right? So in exchange for you giving me the dollars that I need to go out and create this wonderful idea of a company, I'll let you have some of the shares in my company, right? And then if it's a publicly traded company, you can go to an exchange to sell it to somebody else who wants a piece. And you're hoping that you're going to be able to sell those shares to someone else at a later date at a higher value. Or if you can't, that I've paid enough dividends on that stock because I've created a successful company, and your right as a shareholder is to get some of the dividends out of that company.
How many shares does a company have?
It's going to be up to each company individually, right? You can make as many or as few as you want. For a company that's publicly traded, there's what's known as there's, I guess, like the total amount of shares issued, and then there's the float, which are the amount that are publicly traded. So if I create a company with 1,000,000 shares, that's just an arbitrary number. It could be 10 million, it could be 1,000, it could be 69 because it's funny. I can sell some to you. Yeah, and then I can sell some to you, and that becomes the float, or how much is out there available for purchase.
Okay. Do all of the shares added together equal total control of any given company?
Yes, and oftentimes it's much less than that. So each company has their own operating agreement, and based on what that is, it could be how many you need to control that company, right? So it could be you need 51%, some you could need 66. And generally what that does, though, is when you buy shares, you actually get to vote on who becomes the board of directors, and then the board of directors essentially runs that company. So it's a sort of representative democracy to some extent.
Do you have the ability, if you're a company, to only float, say, 40% of your company's total equity as shares?
Yeah.
Therefore, meaning that no matter how much other people accumulate, they never hold complete control over the company.
Yes, absolutely. And you can look at what Saudi Arabia has done with Aramco, right? So they valued their company at around $1.5 trillion, but they only issued about 25 to $30 billion worth of stock, right? So that's what's known as a very low float stock. There's only 30 billion that the public can trade, but the whole company is valued at 1.5 trillion. So they've issued like less than,
So
2%.
the objective of floating a non-total number of stocks from the company's perspective is to make money off of other people speculating on the future worth of that portion of the company.
A little bit, but more so for the extremely tight stuff. It's more so that they want to be able to say, here's a number that what the public thinks our company's value is. So when we go to the bank and we want to get loans, it's easier to say that here's a public fair valuation than, hey, trust me, my company is worth 1.5 trillion. So if you have publicly traded stock, then that's easier for you to go to somebody and say, hey, look, people think it's not just some guy that I paid off to say my company is worth $1.5 trillion. Well, actually, people are willing to pay about $1.5 trillion for
So you're
what my
saying
company would be.
participation in the stock market essentially legitimizes the value assessment of a company, and therefore it's desirable because it increases the confidence of those involved with that business.
Yes, yeah. And so there are non-public companies that exist, and there are stocks that you can trade, but they're not considered as valuable because it's a lot harder to find people who are allowed to buy and sell those stocks. You generally have to be an accredited investor or an employee at that firm, which makes it very hard for you to sell your shares. Right? It's harder for you to go out. It's harder for you to get a fair valuation, and it's really unclear what the true value of your company is and whether or not you're getting like screwed on the other
Tell me
hand of that
about that.
deal.
What's a true
Yeah.
value for a company?
So true value of a company is generally considered everything that they own in terms of intellectual property and all their, I guess, like assets that they've built on top of it, or the goods and services that they have, minus all their debt and liabilities. And then basically their expectations to be able to continue or grow that is kind of what the true value of a company is.
So there's
But that
definitely a
future,
subjective element to an assessment
yeah,
of a company's value.
yeah. So we can go out, we can say, hey, all their, they have 500 widgets that are worth $500 each. They have one plot of land that's worth 10,000, and they have a 5,000 loan outstanding. So you can calculate that. And so then it becomes, do we trust the CEO to take it from just like one shop to like a chain of like 500? Or is the technology that they're making going to revolutionize the world? And so then it gets into forecasting what kind of that future revenue stream is. And that's kind of what makes stocks risky, right?
And this feeds
Because,
into an expectation of eternal growth, right? There's always kind of an
Mhm.
expectation. If a company is exactly the same worth 1 year to the next, that's considered a failure. Every company is expected to trend upwards, as our GDP
well,
has, as our
Well, it
our
depends.
you
It
know.
depends on the stock and everything, right? If we're expecting a company to fail in 5 years, well, the value of that company could basically be the dissolution price of that country in 5 years when you finally put that capital to better use, plus all the dividends it's going to pay along the way. So just because a company, let's say that, for instance, we're going to outlaw gasoline, right? You can still own a refinery stock that will still have some value because for the next 5 years, it's going to pay out. And then at the end of it, you're going to be able to scrap those facilities or sell it to someone who's going to manufacture some other chemical instead of gasoline. And so there still could be some value in it, even though we know intrinsically that company is going to fail.
That's fair. It's not just speculation, at least not always. So, for example, I know every
Mm-hmm.
once in a while these pop up in the news. You have a company that's valued very, very highly. It's some tech startup or some innovative service, and it collapses utterly on itself. And it turns out that they owned and did very little, and it was basically just a self perpetuating hype machine. I think Philosophy
Yeah.
2 brought this up. There was some
Mm-hmm.
business
Yeah.
renting company in the UK, and they were
WeWork.
yeah, exactly. And it seems like
Mm-hmm.
people had an overinflated estimation of that company's worth, and something happened to pierce the veil. And as soon as that happened, it just plummeted, rock
Yeah,
bottom.
well, it happens all the time too. There's like actual straight up fraud, like Wirecard. There's times when company growth isn't going to be great. And so, what's really important too is not that you just have people bidding up the price as like what that fair share of that value, future value could be, but you also have people on the other side who said, hey, this seems like really weird. I don't think this business model is going to work out. It seems like they're taking on a lot of debt and they're not running a lot of stuff, right?
Mhm.
So it's important that not only are there people buying, but there's people willing to like short sell to some extent as well. Obviously, when you go on with the intent to say, hey, this company is like total garbage and it's going to be destroyed and we need to just harm all the workers so I can make a profit, that's bad. But for the most part, most short selling is either done incidentally by market makers
Oh,
or by
hold on. You're
people who
going a
are
little bit
saying,
too fast there.
oh,
Short
sorry,
selling,
go.
we'll have to cover that in a little bit.
Okay,
Um,
sure. Sorry.
yeah, so taking it one step at a time. So to summarize what we have so far, um, participation in the stock market is a means by which people can be invested in the potential growth or downfall of any given enterprise. The enterprises want to do this because selling shares or floating shares is a good way to make money. Additionally, it's a good way to bolster and to legitimize your assessment of what your company is worth. It essentially it puts more people's skin in the game, which
Yeah,
increases
yes.
the total investment in what's going on. But there is a highly subjective element to that assessment at the end of the day, and there will occasionally be, I don't know if this would technically be a market failure, but there will occasionally be upsets where it turns out that something was wildly over or underestimated in value.
Yeah, so you can argue whether or not bubbles kind of are market failures, and to a small extent they are, but for the most part, it doesn't tend to be something that has a massive kind of impact on the market as a whole. And generally, it doesn't really have an impact on kind of efficient markets because it's very difficult to pinpoint when exactly that bubble is going to burst and if it's going to burst by how much and everything else. Those are very, very difficult problems to kind of solve.
Mhm.
So you can still be quote unquote efficient, but still have these kind of bubble behaviors or irrational expectations
Well, it seems like
sometimes.
typically these bubbles are erroneous, and it seems like most of the major players in the stock market, most major businesses have fairly reliable rates of return. They have fairly reliable increases or decreases to their stock price. I'm not so much interested in the
Yeah.
bubbles because I think they, in and of themselves, pose a threat to the economy. What I'm interested in is the extent to which their existence means that investment in a stock is just speculation. So I'll give you an example. Bitcoin.
Mhm.
Bitcoin is worth more the more people buy Bitcoin, basically. Or Dogecoin, I guess, since that's what's hot right now.
Oh,
And
yeah.
and since the only thing that Bitcoin and Dogecoin are based on are themselves functionally, that means that their prices only rise with consumer confidence. There's nothing underlying it. There's no underlying Bitcoin Incorporated that does good one year or does bad one year.
Yeah.
It's
Well,
just
I
speculation.
think those are more of a commodity. One, I think there's like only so many Bitcoin, and that's why people are saying it's a store of value.
Mhm.
And two, it's kind of similar to fiat currency. Well, what's a dollar bill backed by? Well, it doesn't really have any value except for the fact the United States government makes you pay taxes, but that doesn't necessarily mean that it doesn't have value. The point of these kind of things are to facilitate transactions between people. Because if I'm trying to buy a house, and I work as I don't know, like a sheep shearer,
Mhm.
and the guy who owns the house doesn't want 400,000, pounds of sheep wool. I got to go find 400,000 people who want things that the house owner wants, and so it makes it very difficult to facilitate that transaction. But if we have dollars or whatever you want to use as your medium of exchange, rubles, yen, bitcoins, doge coins, whatever it is, as long as it's an acceptable substitute, then we can kind of use that to change our needs, right?
Of
And then
course,
that way
though,
I can also,
in a pragmatic sense, I mean,
yeah.
Bitcoin doesn't function well as a currency because of its rapid and wild fluctuations. The US dollar has a really reliable interest rate, or
Mhm.
which
Yeah,
we know a dollar today, the next year is going to be worth like
98
99
cents.
or
Yeah.
98 cents maybe, you know? Whereas with
Yeah.
Bitcoin, for all we know, next week the price could plummet or could skyrocket, you know?
Yeah, but if you look at a lot of developing nations, I think their currency fluctuation rates are way wilder. So while it doesn't look attractive from us and like a Western perspective, well, if you're living in a country that's undergoing hyperinflation, or if they're undergoing a lot of economic or political instability, these incredibly volatile digital assets can actually look okay.
That makes
I,
sense to me. I don't necessarily have an issue with
yeah.
the concept of blockchain or cryptocurrencies.
Yeah.
Though, as I understand it, Bitcoin in particular has some really weird ecological consequences, something about the way they're
Yeah.
produced. I don't know the specifics, but it's not really tied to the stock
I
market.
know
So,
they have like a shit ton of like data centers and they burn more energy than Denmark or something. I
yeah,
saw that stat
that's
come up. It's like pretty. It's pretty. Yeah, I don't
that's
know how I
pretty
feel about
impressive
just. Well, it's pretty impressive, but it's also pretty damaging to the environment at the same time.
in an impressive way.
Like,
Yeah.
yeah.
Um,
So,
so we have So when a person buys into Bitcoin, I would be willing to bet most people don't use it as currency. Most people use it speculatively. They're hoping to sell when it peaks at 1 million or whatever. That would be my guess.
Yep. Yeah, that sounds right. And a lot of people are saying, well, it's better than fiat because there's only 21 million. That's what the latest billionaires are saying. I think Michael Saylor said it, and Elon Musk said it. But I'd have to go check. I don't know. I don't
Right.
do that much
I can't
with
speak to
Bitcoin.
that, but I'm interested in this because right now Bitcoin's doing really well. There's
Mhm.
nothing underlying it. Bitcoin's success, Bitcoin's worth is people's faith in Bitcoin. But then you have another company. It is conceivable for a company that is remarkably productive to have its stock price and the value of the company plummet massively, is it not? Say if there was misinformation that spread in the market, something that made people think they had to sell, 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 and everyone
Yeah,
panic sells, it turns out to be misinformation. The company is unchanged. Nothing there has changed, but all of a sudden the company is worth a tenth what it was the other day. This is
yeah,
a thing that can happen, yes?
yeah. That's totally possible,
Mhm.
and totally plausible, right?
Oh, okay. Yeah.
Yeah, it's totally. So the thing is, depending on what the source of the misinformation is, that's pretty heavily regulated. So uh, if you were to just make up things about a company or something, and they weren't true or substantiated, then you would be getting in a lot of trouble for it. At least here in the United States, I can't speak to all the other markets around the world, but for the most part, what the SEC tries to do is have kind of fair and orderly markets. So fair being everyone who participates has an equal chance at a slice of the pie. Whenever information comes out, it's shared between all participants at the same time in the same place, and so they all get it and they can process it at their own time. And orderly such that there are circuit breakers, so that if misinformation or something comes out and a stock goes way up or way down in value, they'll pause it so everyone can take a minute to think about what's happening, or 10 minutes, or depending on the circuit breaker and everything else, to just like reflect and say, hey, is what you're doing really rational? Or at least that's the reason behind a lot of the regulation that we have.
I remember there was a really interesting Tom Scott video where he said that there were these I don't know the technical term, but that they manage stock market transactions. It was built, and because stock market transactions are all done by computers these days, what they'd done was they had a length of fiber optic cable run around in a spool in their building that then led towards the central database at the New York Stock Exchange. And that spool actually delays computer transactions between the institution and the stock exchange by a fraction of a second because info travels at the speed of light. But if you ravel a
Mm-hmm.
fiber optic cable up enough, I mean, you delay
Yeah.
that
Well,
transaction
there was
process.
also people who built radio telescopes from Chicago to New York because it was faster to send their information over that line of sight than it was to send it through a cable, right? So that fractional, like microseconds that you're talking about, isn't really going to make much of a difference for individual traders. Sure, there's some arguments around HFTs and those things that they do, but for the most part, all the market participants are now allowed to co-locate their servers. So they can all essentially rent a server and park it in the same room as the exchange. So you no longer have to worry about those kind of shenanigans.
Interesting. It's just interesting to me how at this point everything is done by the picosecond with these exchanges. So there's
Well,
and
it kind of depends on your investing time frame and everything else, right? If you look at what Warren Buffett does in terms of his investing style, he's buying a company for 30 years, right?
mhm.
If he's going to buy a company and he's going to hold it for 30 years, what's a picosecond going to mean for him in terms of his returns, right?
No, not
Maybe
in
he
stuff like
loses.
that. Probably more like if you're on margin or if you're looking to sell or buy at a very specific price. At that point, maybe it'd be preferable
Well,
to have the
well,
fastest possible
no, because
interaction.
if you're looking to buy or sell at a specific price, you can put in limit orders
Mhm.
and they'll always execute in the order that they're placed in at the price that you want. If you're trying to hit like a bid or ask with like a market sell or a market buy, well, then yes, that could influence you. But for most retail traders, that's a very, very dangerous game to be playing, to make your trades try to make fractions of a penny to try to make a little bit of money out of it. That's not a very good investing strategy.
Interesting. Okay, that's something that I would have to look more into. So pulling back for a bit, with this with this Wall Street bets
Hmm.
nonsense. So we all had, or a lot of us had, our populist takes to begin with. Since then, I've tried to read up as I could. Do you mind if I attempt to summarize the situation as I understand it?
No, please go ahead.
So, as I understand it, GameStop hasn't been doing great lately. So there were some hedge funds, which are organizations that manage other people's money, often to the tune of trillions of dollars, um, decided to short GameStop, which is to say that they borrowed shares of that stock at its current price and then waited, expecting the price to decrease. Thus, meaning that they bought them at their current, or they borrowed at their current price, sold them, and then wanted the prices to decrease so they could buy them back and return them with interest, and they would make money off this process. This process only works if the price reliably goes down. So a bunch of hedge funds and some enterprising folks on Reddit noticed that the stock was being shorted and instead pumped the price up by buying a lot of the shares that were floated. And in doing so, they did fuck over some hedge funds. Other hedge funds made quite a bit of money from it because anything that Reddit notices, they're going to notice probably before. And while a lot of early investors made a lot of money from this, the problem is that at the end of the day, this is kind of a pump and dump scheme where somebody gets left holding the bag at the end. It's all well and good to, I think the term is called a short squeeze, to pump up the price so that the person doing the short selling is fucked. That's all well and good, but at the end of the day, if everyone's buying into this, eventually somebody's going to buy GameStop at $300 a share, and then the price is going to go down. And some people bought in quite a bit. Would you say that's a accurate summary of what happened, more or less?
Yeah, so I can add a little bit more flavor to that.
Mm-hmm.
So I don't think I know any individual hedge fund that is trillions of dollars. So I think the big ones that you're thinking about, like BlackRock, obviously, these are kind of wealth managers or asset managers. And so they have a large number of separate funds that they run. So it's not really, so it may be one advisor for all of these, but these are a lot of separate vehicles. Also, in terms of like how big a hedge fund can be, well, you could set up your own hedge fund for yourself with like $50,000 if you really wanted to. Actually, you could probably do it a lot cheaper, I guess, if you're just doing it for yourself. It's basically a hedge fund is basically a pooled investment vehicle for multiple people to get put their money in and invest in something. And a mutual fund is a similar thing, but it's accessible to the general public instead of accredited investors. So if you wanted to
Who are
get
accredited investors?
so, per the SEC definition, an accredited investor is somebody who has either 1 million in net worth outside of the value of their primary home. They've made 200,000 per year for the last 2 years, and have the expectation to make that next year, or that number is raised to 300,000 if it's combined with their spouse. And now they've updated that to be holders of the series. I want to say it was 765 and 82 licenses. I'd have to go double check, but they
Yeah,
just
I was curious for a
updated that.
second that it was just
Yeah.
being able to make money. If that's the case,
Oh,
then
yeah. Well, that's really weird because these rules and regulations they came out in the 1930s in response to the big stock market crash, right? And so these numbers haven't been updated. So as you can obviously imagine, $1 million in 1939 or 1940 is a lot different than $1 million today, and these have never been updated. So these are very antiquated rules.
can a poor person become an accredited investor?
So now they can, yes, with the expansion of getting the 765 or 82. I believe the test is about $150, but generally, or maybe it's $80. I don't know what that is. I'd have to go look, but you'd have to study for it. Obviously, you need to get study materials, and that can be pretty expensive. So the answer to that is no. On top of it, generally, hiring an investment manager is pretty expensive. I want to say the average fee is 1.5 and 15. So they take 1.5% of everything that you put in and 15% of all the gains you make, which doesn't really make it a desirable investment for a lot of people, unless you're looking for something for unique strategies that can't simply be done. And for the most part, a lot of these funds just lose a lot of money for their investors compared to if they just like bought like a broad market index fund, right?
Yeah, as I
And they perform
understand
worse.
it, because everyone's heard this some version of this factoid, which is
Yeah.
a bunny rabbit eating carrots off of buttons predicts better market, growth than 20 experts, or monkey on a keyboard, so on and so forth, that whatever mechanisms lead to consistent growth in the market seem to be fairly elusive to our experts, though there are
Yeah,
obviously
well,
reliable bets just by investing in, like you said, a broad index fund, right?
yeah, and so there's a lot of other ways that they make money that they're trying to do it in ways that aren't necessarily correlated to the markets. So, for example, high frequency trading firms, you can invest in those if you have enough money, right? You're accredited, and then they make money kind of trading on the high frequency spreads, or they make strategies that are designed to kind of hedge tail risk in certain down markets or things like that. So it's not necessarily something that that is bad. And there's a lot of unique things that they do. It's just not necessarily
Well,
the
I
best
think
thing to
all of
do.
this is bad, of course, but right,
Yeah,
relativistically.
well, I mean, if you think, yeah, I mean, sure, if you're going to think it's all bad, you're going to think it's all bad. But they do things that are kind of uncorrelated. That's kind of the meme now, is that if you invest in us, we'll get returns that will happen regardless of what happens in the market, and that's the selling point for
Well,
this.
that would be the dream, of course. Um,
Yeah.
okay, so in your opinion, did anything illegal happen with regards to this whole GameStop fiasco? Or actually, I should say two questions. Did anything illegal happen, comma, did anything unethical that should be illegal happen?
Yeah, so I think the most egregious thing was probably what happened on social media. There was a lot of people getting people behind the hype. I think that was pretty immoral. I think Chamath and I think it was Musk who were tweeting out like buy GameStop, and they're getting screwed. Or Robinhood screwed people. It was like very, very immoral. I don't know if it's illegal or not. The SEC is going an investigation.
Mhm.
I think potentially on the Wall Street Bet subreddit, I know that there was a lot of accusations of mods deleting posts of like people losing money or saying to sell or things like that. I think that's very influential.
Mhm.
In terms of anything illegal happening, I don't think anything did. I think there's going to be a very big question, though, around the halting of individual stocks versus everything. And I'll kind of put forward the case for both arguments here.
So to lay
So,
out before you say that, just so everyone's caught
mhm.
up. So what you're saying is, back when everyone was buying GameStop, Robinhood, and a couple other trading apps, they shut down the ability for that specific stock and a couple other ones to be traded. And the reason they did this, so well, they didn't actually claim this. I think other people have speculated this, but the reason why they did this supposedly was because the more volatile a stock gets, the more money they have to put forward,
Yeah,
the
so
more collateral they have to offer up. And the volatility was so high that they were having a liquidity issue. They weren't actually
well,
capable.
it's more of a margin issue than a liquidity issue, right?
Okay.
So what we have is what's known as a T+2 clearing system, where if I buy a stock from you, it takes you 2 days to deliver that stock to me, because for whatever reason in the 1980s they decided that that was a good system, and we haven't updated anything for years and years because you know how regulation kind of goes.
So if
And
I
so
buy
what
a
happens is,
stock, that actual thing doesn't happen for 2 days.
yeah, but so your broker then has to put up some collateral in order to be able to say that, hey, in 2 days I'm going to give you the dollars, and then the other side's broker has to put up money as well that
Mhm.
says, and I have the money and I'm going to deliver the stock to you in 2 days. And so if they don't meet that obligation, it's called a fail to deliver, and then there's a number of mechanisms that'll handle that. But the point of the collateral is so that in 2 days that transaction actually goes through. And
Okay.
so, generally, when stocks aren't fluctuating very high or very much in value, well, you really only need to put up maybe 25% of the stock's value in collateral, right?
Mhm.
On a usual day, your brokerage and your clearinghouse will be both selling stocks and buying stocks in relatively equal numbers. So the amount of collateral that you need to put up isn't all that high. But what happened
Because there's a
was,
low likelihood of some kind of market fuckery getting in the way of the expected
yeah, well, and then also,
components of the transaction over the next two
right, and
days.
your expected debts and obligations kind of balance out, right? If you sell something for 10,000 and someone owes you $10,000, well, your net expectation of that is like zero, rather than if you sell something for $10,000 and sell another one for $10,000,
Mhm.
because that's now minus 20,000 instead of about zero.
Okay. Is there any modern need for that 2-day delay, or is this a
Nope,
component?
that's something that you guys should talk to all of your congressmen and women about,
Because
your
back in the
state reps.
day, if you wanted to buy a stock, you had to like send a guy on horseback, and he would.
Well, yeah.
Yeah,
So, I mean, even in the 1980s, when that rule came about, there was an option for a 0 day or a same day settlement system, and they chose not to go with it, and they still haven't updated it. And it's quite frankly pretty ridiculous, if we're being honest.
interesting. Do you
And
think this
then
does
we also,
damage to the market?
a little bit, in terms of, at the end of the day, it doesn't really matter all that much. It could just be a little bit more efficient. Um, if you're talking about, if I had a ballpark of like 0% damage to 100, it would probably be around 0.5%, maybe. In terms of damage, there's a little bit that's affected, but at the end of the day, the market still functions fairly smoothly, and there's a lot of big processes around it that have come about that have made things run relatively smoothly. But
Gotcha.
I think there's a lot of middlemen that definitely could be taken out of the whole transaction process, who are taking little bits here and there. Um,
Okay. So that would only really be an issue in these incredibly rare, incredibly high volatility
well, so what happens
situations.
then is it just increases margin requirements, right? So a lot of well-capitalized brokers and clearinghouses didn't have problems transacting, right? So
Just
Vanguard
Robinhood
has
because
like a
they're
trillion.
a
Yeah,
retail. Yeah,
yeah. So Robinhood is a new upstart brokerage. They manage about 20 billion, I think is the number. And so their margin requirements were normally around $25 billion. So they have to have essentially borrowed money to put up their normal collateral requirements. And I think that number got up to like 35 or 36 billion. And so in order to like meet their needs, they had to do two things. They had to go out to all their banks and draw down all the loans they could to put money in, and they had to go to their investors and sell them more equity in order to meet those things to allow people to trade. The second thing that happened there is the central clearing. This is my understanding. I don't know how exactly this conversation went down or what went down. I assume that they got told, you need X billion dollars in your account in order to continue trading. Or you can have Y billion, which is less than X, but you're going to be limited to this number of Gamestop, AMC, Nokia. I don't know what the other meme stocks are being traded, but you're only going to ration out so many of those per day. And so they said, well, for the sake of most of our customers, a lot of them aren't trading these meme stocks, so we still want that to be functional for them. And then, in order to be fair to all of our customers, instead of letting one guy buy up all of allotted, I don't know, 10,000 shares of GameStop for the day,
mhm.
well, we're going to give each person one, so they can have, so we can at least try to treat everybody on our app
So
equally.
we can
It's
all
it's an
be together in this. Yeah, okay.
misery. Yeah.
Uh,
So the question then becomes, well, what's the right thing for Robinhood to do, right? Should they have shut down trading on that one thing, or should they have forced everybody to kind of wait to be able to make trades because they couldn't meet their margin requirements? Is there a better way to distribute the trades that they're allowed to make? It's a tough question. I'm not a regulator. I don't know how I would answer it,
do
but
you
I mean,
think
if
they should have been forthcoming with the liquidity issue? Because it seems like as a business
so,
doing that's a really bad idea.
well, there's a difference between a liquidity issue. So when you're talking about a liquidity issue, that basically means I don't have money to pay my bills, right? If you say liquidity issue.
An
Yeah.
inability to meet the collateral
Yeah.
necessary
So
to
I
front
think
these.
when
Yeah.
Vlad went out and he had his conversation, I think he should have talked with the PR guy more. I think what he did, it was an awful PR statement. But at the end of the day, I think a lot of the retail blame, all he really could have done is shifted it to like the central clearinghouse and like shifted responsibility. But at the end of the day, the end result for his end users would have been the same. And I think a lot of the same outrage would have just been redirected, maybe not on Robinhood, but to a different responsible organization.
Though
Um,
the more you distribute blame, the more abstract and difficult to pin it is. I wouldn't be surprised if a decent number of people left Robinhood after that because they assumed that what Robinhood was doing was like playing buddy buddy with their hedge fund pals, which
Yeah, so
Is always,
there's a lot
I
of
suppose, a
things.
threat in the broad sense, but in this instance, seems like this was
Yeah,
just a
so
natural consequence of market forces.
we can talk a little bit about what Robin Hood does that I don't really like
Hmm.
personally. So the first thing is Robinhood acts as a third-party marketer, as a brokerage, and as their own clearinghouse. So generally, these are thought to be kind of checks and balances for each other. But basically, Robinhood uh, is in the business of getting you to trade on their app. They want you to trade a lot on their app, and then they control their own collateral through their own clearinghouse to the central clearing corporation in order to kind of cut on money, right? So they can keep everything. They say it's for the cheapest for the customer, because if they do all those things rather than paying somebody else because they can do it cheaper in house, that leads to a lot of potential conflicts of interest and things like that, which on a very high level, that looks a little bit sketchy. The second thing that they do is payment for order flow, but the way they do the payment for order flow, I think, is almost harmful to consumers. So generally,
How
in
so?
finance, so there's like
Sorry, I
what we
interrupted
call the
that. You were telling
20/80
me.
rule. Yeah, so if you take 20% and you give the person 80%, well, that's like on its face, it seems like reasonable, right? So when when other brokerages go to market makers and they sell your order flow, well, what they do is they give the market maker an option to give you, so they have to guarantee that the order is going to be at the best price on the market or better. And so if you're market selling, and the price for GameStop is $55, well, the market maker has the right to take that transaction, the other side of that transaction, and then get a better price for you. So if they get it for $54, well, they've now saved $1 on that transaction. If they return 80 cents of that dollar to the retail trader who now gets 54.2 instead of 55, well, then that's generally considered okay, and then that market maker will recompense your brokerage for making that transaction for you. So in the end, the retail guy is better off that the order went to the market maker rather than flowing into the market itself. But what Robinhood did was, in order to maximize their revenue, they went to these places and they negotiated against their customers. They said, hey, you should take more than 20% so you can pay us more back, right? So of that dollar that would be saved by going to that market maker, they would say, all right, you should keep 40 cents so you can pay me 20 or something like that. I don't know what the contracts are, what the negotiation was. I just know that they were actively negotiating that cut to be significantly worse than what the industry standard was so they could make money off of your transactions, right? And I think that kind of feedback model of them getting paid for each transaction that you make leads them to design you to overtrade. And the Massachusetts Securities and Exchange Commission actually sued Robinhood over this gamification of the trading, right?
Okay. I think I might have to rewatch the VOD to fully appreciate that, but I think I understand what you're saying. Essentially, they're, to put it really, really simply, they're putting forward and advertising a service that seems as though it offers a more equitable opportunities to retail investors, but it actually ends up costing them more in the long run.
Yes, correct.
Okay, okay, good. Okay, okay. If I get the general thrust of it, then I think I did good. I did a good job.
Yeah,
Um,
I would just add on
mhm.
that it's not necessarily a bad thing that they're getting rebates because you are saving money on commissions, and this is only for order flow that you put out that is a market order and not a limit order. If you put a limit order that won't be executed in the market, that is very, very rarely picked up by market makers who actually want to improve the price on that. So that is basically when you click buy now or sell now versus like wait till the stock hits $25 to buy or wait till it hits $50 to sell. That's generally how that goes.
Gotcha. I want to pull back to some broader topics. There were a couple of
Mhm.
people in chat who are asking some quick things that I'll just answer really quick. Somebody asked what a
Sure.
margin is. Please correct me if I'm wrong. As I understand it, a margin, or selling on margin is just when you borrow to sell. You borrow money to sell,
Yeah.
or you
So,
to buy a
well,
stock. Sorry.
yeah,
Um,
and Reg T limits U.S. investors to 100% margin. So if I have $1, I can buy $2 worth of stocks. and that's the most that you're allowed to take.
So there's a limit to margin, but there isn't a limit to shorting as long as there are people able to borrow.
Yes, and so so what happens is your margin requirement for those shorts is going to vary by your counterparty, right?
Mhm.
So, for instance, if you're going to borrow from me, I can say Vash has a ton of money. I know he's good for it if GameStop goes up from $50 to 500 on that short. I know he's a successful YouTube streamer, so I know he's going to be good for like $450. So I don't really need that, right? But if I go to somebody else, I could say, hey, you know what? That looks really sketchy. I'm going to need you to put like $500 of collateral up to borrow that stock. And so, depending on your relationship with who that counterparty is, what your company financials are, or things like that, they're going to require you to have different amounts of margin available. And the same thing with your individual brokerages. So, as an individual investor, I think if you get approved for margin, you can also go short yourself. And so each brokerage is going to have their own requirement, right? And at some point, when the money in your margin account goes down, they're going to call you up and say, "Hey, Vosh, I know you're probably good for it, but I'm going to need you to put another $100 in." And if you don't, they close out the position. And so that's what happened to
Okay.
those big funds. Yeah.
Okay, and also we had Robinhood was selling people's GME shares because they had bought them on margin, and they had hit that threshold. As I understand that, that's generally considered like a shameful thing, right? When a margin gets called, like it means that you fucked up somewhere if that's happening to you.
Well, that's not necessarily like always a problem, right? It's you're going to have losing positions, especially if you trade on margin.
Hmm.
But that's not really a shame thing, right? Do you shame your kid when he fails a test? Like he made a
Well,
mistake,
maybe if you're a bad
obviously.
parent. I saw there was a
Yeah.
meme in this was before everything went down, but in Wall Street bets they would it was like a bad like if that happened to you it's like, oh, you fucked up, buddy. But I guess
Well,
if you
back in the
invest
day, you
enough,
would
it's
post loss porn and people would laugh. But yeah,
yes. I only
yeah.
visited Wall Street bets a couple of times before this whole thing
It's
went
a
down.
cesspool. Like most of the people who are investing, especially on the online communities, they tend to lean pretty crazy. I would say like male, very conservative,
Mhm.
interesting, creative choice in language and descriptions.
That's one way of putting
Uh,
it. Their Discord server
yeah.
got shut down for hate speech.
Well, I mean, they did call, their weekly options were friendly desserts, but you can fill in with your favorite slur if you want to. So it's really not surprising.
Yeah, my brief experiences with the community, it almost seems pulled here sometimes.
I
Um,
mean, I wouldn't be surprised if there's major overlap between people looking to make a few quick bucks because their life's like not in a good spot, and people going into investing. Right? I think
yeah.
that the overlap in that demographic, especially when they don't have a lot to look forward to, kind of tends to like blend together in that region.
Okay, that makes sense to me. So you would agree with me, and I want to cap this with a responsible with some responsible messaging that if you're a retail investor, as in you're an individual, you don't have any special hands in on the business. If you're a retail investor, generally speaking, you should invest in solid and safe index funds for consistent and reliable growth that'll pan out way the fuck better than just leaving your money in a bank account.
Mm-hmm.
That you should do that. And if you're ever going to engage in speculative investment, like throwing money down on a particular stock because you think it's going to go up, that is only something that you should be doing with money you can afford to lose and with a great deal of research. And even then, you should probably wait a day to think about it before going for it.
Yeah. So my chat's screaming for me to plug VT.
This
So
is
for
not
what
financial
VT?
advice. This is what I
Yeah.
would do hypothetically in a video game.
Yeah, yeah. So VT is just like a world index fund, I guess. It's super low cost. A lot of people like it because it's generally a good bet that the world economy is going to go up. I would say another thing to look at too is what your cash needs are going to be for the foreseeable future. And if you can't tolerate the speculative risk, you can always get slightly better returns in terms of bond index funds than just holding cash, but it'll be safer than, say, investing in stocks. And then if you even have like $100, as long as you're like kind of young, or even if you're a little bit older, if you go to like most major financial institutions, they'll generally assign somebody to like spend an hour with you, learn more about your life and what your needs are, and actually recommend some pretty good stuff to you. You always want to make sure to ask like how they're getting paid if they're putting you into funds with high sales loads or things like that. but generally, a lot of these places, they'll make a lot of money over the lifetime of your business. So they're willing to invest like an hour or two to like build out like a general investment plan with you. Because they want to keep your business for the rest of your life, and so they're willing to like give you a couple $100 worth of one of their employees' time to like walk you through like what your individual needs are. So I would recommend that for most people.
That
So
makes sense. Sometimes I do feel like me in a video game. Sometimes I do feel like speculative investments can be reasonable. I know for a fact when the pandemic began, I thought, fuck, Amazon's going to go up. It has to. Everyone's going to be ordering online. And that did end up happening. I think it went up by about 50% from first quarter 2020 to the end of 2020, more or
sounds
less.
about right.
And so I guess that would have been a good buy-in. Do you think that making judgments like that with money you can afford to lose after thinking about it, do you think that's something that people can responsibly engage in?
Yeah,
Or is this a
yeah.
house always wins situation?
So I think you can, but the most important thing that you have to ask is what new information am I bringing in to the market? Do I think that this information hasn't already been priced in?
Hmm.
And then, if so, then yes, that's the point of an efficient market. Is a lot of people come in with ideas, either that things are going to do well or poor, and the sum of everybody's collective decisions gives us a ballpark fair price. So if you're coming into the market with, hey, I think this pandemic is going to be a lot worse than what people are saying. I think that there's going to be a lot of boomers that are now buying from Amazon because they don't want to get coronavirus outside.
Hmm.
Well, that's something that you can add information into the market and you could get paid for it. But on the other side, you could totally get crushed, right?
Of
So like
course.
what happens if this thing ended up being like way more deadly and Amazon lost half of its warehouse workers, right? Where would you be? And so the most important thing in investing is always risk management. A lot of these leveraged index funds and things look like they're going to be great investments because they only go up, but it's kind of sequence of returns and increased volatility can have really, really bad performance hits. And knowing that you being able to reflect on your position and say, hey, this isn't working out is very, very important. So you can't just think about the upside. You have to think about the downside, do things within your risk, and make sure that you're thinking about what happens if your decisions go wrong as well. So,
And what you said there, that the market has already priced it in, that's a thing that you should expect. Because generally speaking, the likelihood that a retail investor is going to speculate faster and more reliably than all the powers that be that operate in Wall Street, generally not that likely. Though pricing something in doesn't happen immediately, as was the case with
mhm.
Amazon stock, it climbed gradually in
Yeah,
like
absolutely.
March and onward. But often these like sudden shifts, by the time you know what's happening, it's almost too late.
Yeah, but here's the thing: most of this stuff is public information. So if you're looking to add stuff in, you're either going to have some new predictive model, you're going to have to do some sort of like independent research on your own for the most part. So a good example of this is the movie China Hustle, right? They literally flew out to China to kind of count the number of trucks coming in and out of some of these paper plants, right? They were getting information that was publicly available, but no one had actually gone out and gathered, right? So if you just think, oh, the coronavirus, Amazon's going to go up, well, someone's probably thought of that, right? But if you're out there, flying your drone over like the oil pipelines or something that they're building, and you're seeing that progress has slowed, well, maybe that's like not public
How
information yet,
far does
right?
that go? What if you used a drone to spy, like, or to like look down on business people and you can like lip read them? Would that be insider info if you
Well, if it's
traded off
happening
that?
in the public without the reasonable expectation of privacy, then I would think probably not. But if you are like hacking your way into Microsoft to like listen in on like their meetings, then yeah,
You
that would
need
be
what you need
pretty
is like
overkill.
those long range like those infrared scanners, and you like follow the stock people, and if there's ever like a heat spike, you're like, oh shit, sell or something like that. Okay, we're almost out of
Yeah,
time because at the top of the hour I'm speaking to another person, but I want to
no,
ask
don't worry
something a
about
little
it.
broad. This
Sure.
isn't a leading question. I'm not trying to bait or anything like that, but I genuinely want to
Mhm.
know, what do you think our economy would look like without Wall Street? if we didn't
I,
have any system of speculation or of buying into ownership?
Yeah, so I think we would be very, very far behind where we are now. So, access to public capital markets and solid central banking has led to tremendous growth in terms of businesses. It allows people to connect to businesses, and there's to some extent a barrier kind of lowered because these publicly reporting companies have to meet high audit standards. There's a lot of compliance and things that they have to do. So the average investor isn't getting fleeced like they were back in the day when some guy would come by, offer to sell some securities and disappear. Obviously, there's still a lot of regulation that can be done. There's bad regulation out there that
I
needs
would
to
need
get
to research
removed.
that for a long
Yeah.
time before I felt
Oh yeah,
comfortable
yeah,
with.
that's fine. There's
Yeah.
bad yeah, so there's bad regulation that can be removed. There's good regulation that can come forward, help make things more efficient. There's, I think, but in general, I would say financialization of a lot of goods and services has led to a lot of progress. It's led to a lot of entrepreneurs being able to launch businesses, small businesses, large businesses, everything in between. And at the same time, it's also been used for a lot of fraudulent things. You can go to the SEC's website. They give press releases every day, like hedge fund manager caught for fraud, or business caught for fraud, or illegal securities offerings and things like that. So,
And of course, we do have these crashes every once in a while. Of course, we had 2008, and we had the Great Depression, which were
yeah,
at least in part caused by these
yeah.
processes.
If you want to talk another day about 2008,
Mhm.
it's way, way, way more complicated than people think,
Wasn't it
and
like
I think it'd be a good topic.
subprime mortgage loans
So
being
that's
packaged
kind
with
of
AAA loan packages, and people were
yeah.
buying?
So
Yeah.
so that was kind of like the start, right? Someone lit it on fire, and then Henry Paulson and the Republicans thought that it would be great if they aligned themselves with short sellers. So instead of like trying to act as a lender of last resort and stabilizing our financial system, they basically went and started tearing down institutions, which aligned with people who were trying to essentially tear down the economy at that point and make a ton of money along the way, rather than acting as the government should, which is on the side of, hey, we need to stabilize and normalize things. And so there's a whole mess of bad regulation that came through. There was companies that had just raised money that were nationalized by governments, and then investors said, well, I just gave you money 2 weeks ago and the government took it, I'm not touching anything. And that stopped a lot of flow of capital to stabilize things. So that was just kind of like the tip of the iceberg. It was like the first domino, if
Okay.
you would.
Then I'd have to
So
look more
yeah,
into it. That's one of the
yeah,
frustrating things about economic. I don't know if this is my
yeah.
bias because I got into sociology, but I feel like a lot of sociological answers are very intuitive. If you understand the
Mm-hmm.
basic principles of how humans interact and how social expectations form, I think you can arrive at a lot of advanced conclusions. But with econ stuff, you have to be familiar with a lot of
Yeah.
incredibly intricate.
Yeah, if I could recommend a book for you to read to at
Please.
least like give some insight, I think a lot of your audience would do from it as well. It's called Economics 4.0 by Antony Koletsky, a Russian economist. I think he provides a lot of insight. I don't agree with everything he writes in that book,
Mhm.
but his description of a lot of the stuff that happened behind the scenes is it adds a lot of value. I think
This is for
it's a
2008.
yes, for the
Okay.
2008 crisis in particular. He obviously gives some prescriptions for like how we can make our government better and more resilient and make capitalism better, which you and your audience may not like. But it gives another perspective on some of the behind the scenes things that don't really get reported on, but had major major impacts in terms of like the actual workings of our financial
Well,
regulation.
you need to understand the
Yeah.
system to criticize it. I mean, that's why Marx
Mm-hmm.
was a cool
Oh,
dude,
sorry.
right?
It's capitalism 4.0, not economics 4.0.
Yeah,
Sorry,
I got you.
capitalism 4.0. Yeah, yeah.
Yeah,
Um,
you have to understand these systems to criticize them, right? I mean, obviously,
mhm.
Das Kapital isn't as relevant today in all of its assertions because the economy has moved on quite a bit in the past 140 years. But in many ways, I mean, it was remarkable for its time because he took the time to understand the underlying systems, and I think that a lot of people shirk on that, including myself. So it's
Yeah.
something worth looking into. There is one last thing I think, one final point.
Sure.
What would a stock market look like if it represented only investment but not ownership? Because technically, in a market socialist society where every firm is owned collectively by the people who work there,
Mhm.
you couldn't sell off shares that would give other people control over the company. The workers control the company. But you could still have an investment enterprise based around speculation. Would that meaningfully change how Wall Street
Well,
operates?
Well, I think so, because if you can't like sell your share to invest it in somewhere that's slightly more efficiently, I guess you could like control the bank account balances to reallocate capital to other places, but I think it would be very complicated to figure out something that would work and be as effective and not impactful on the day-to-day operations of these companies, right? Because when people are driving up and down the value of the companies, well, they're not actually taking capital or labor out of that company. They're signaling, they're trading the shares of it rather than affecting the everyday thing.
It'd
And
be
if you
like
can't,
bonds, basically, right? It would be like, yeah. I mean, I imagine from the retail perspective, it wouldn't make a difference at all because no retail investor can ever buy enough shares to own a company. I mean, not in a reasonable way. So I imagine from that perspective, it'd be basically identical, but you wouldn't have shareholders, which means you wouldn't have shareholder boards or meetings, which means the entire system of how these decisions are made would
well, I mean,
change.
you would essentially have shareholders, but your composition of the board, instead of being either the creators of the company who have maintained majority control or the people who have now purchased that company, it would be a different representation on that board. Sure, yes, your composition will be different, but I think effectively you would have the same kind of hierarchy at the end of the day.
Well, I
Just
don't
the
like
people who are
hierarchy.
voting on. Well, I mean, what if someone's making decisions for the company, right? At some point, there is a hierarchy, even if it's flatter than it is now.
Oh, of course, there's always going to
Yeah,
be.
yeah, yeah.
Well,
Sorry, yeah, that's what I mean. I
But
don't
right, of
mean that
course.
like you're going to trample the people, but
Some
yes, there's.
hierarchies are just and some
Yeah,
aren't, whatever. I'll
yeah,
look
yeah.
more into it. I think it's interesting to think about. I appreciate you coming on.
Yeah, and thanks for having me on in front of all your people. If you guys want to come get Reason Takes, you can find me on Twitch. I'm just Rage Pope, and appreciate it.
Oh, are you familiar with the book um of Thomas Piketty, 21st Century Capitalism?
Capitalism in the 21st Century.
Yeah.
Yes, it's a very, very good descriptive book. He followed it up with something that you might like. I personally don't like the prescriptions in his new book. I'm totally blanking. It's on my bookshelf in the other room. I could go get it, but it's a very good read. I would recommend you read that one as well. So he's Parisian economics, so he's
I
going to
love
push for
reading.
a lot more of a welfare state. It's someone in my chat's got to have it. Capital and Ideology. There we go. Yeah, and so his first book is amazing. It's probably the authoritative book on capital flows and income, wealth, and income inequality. But then his second book, Capital and Ideology, I don't think takes the right approach to the kind of income inequality that we're seeing. But that's a discussion for another day.
Okay, all
If
right.
you're,
I guess I'll have to lend my opinion to that matter if I can.
so the first one is Description. Yeah, you love it. It's a great book. I would recommend everybody read it. If you want to talk about wealth and income inequality, you have to read that book. It is the definitional or the seminal book in that field that now I would guess. And then he has his Capital and Ideology that follows up. And there's a lot of other ones that have responses to that book and prescriptions. But that's a very, very good starting point. And I would recommend all of your people read it if they want to talk about wealth and income inequality.
All right. Thank you for coming on, Rage Pope.
Yeah, no problem. Thanks for everything, and enjoy your next conversation.
Of
Take care.
course. Have a good one.
Take care. Bye.
Bye.